Good afternoon, good morning, ladies and gentlemen. I've got an excellent worldwide audience with us today, and thank you for joining us for this session on the global regulatory agenda in the face of COVID-19 with Ashley Alder. I'm John Orchard, OMFIF's CEO. Ashley is the Chief Executive Officer of the Securities and Futures Commission in Hong Kong, which he's done since 2011, and has just signed another 3-year term for, in part to see the financial centre through the COVID crisis, and we'll talk about that in a moment. Ashley, who started his career as a lawyer in London, is also chair of the board of the International Organisation of Securities Commissions, or IOSCO, which he has been since 2016. Ashley's going to take us through a couple of slides, as Angela mentioned, on the things that on his and his peers' intros at the moment, and then we'll get into questions from me and also the audience. As I say, we have a great mix of central banks, multilateral organisations and finance institutions on today. So do please put your questions and use the chat function to do so, and I'll address them to Ashley as we go. So thank you for joining us, Ashley, and over to you for your brief presentation, and then we'll get into questions. Thank you.
Great. Well, this will be a very brief presentation because I think we do need to get into a conversation and some questions. It's always more interesting that way around, I think. So yeah, global regulatory agenda in the face of COVID-19. Well, I won't be able to cover that in an hour. There's no doubt whatsoever, because it's both, but you know, it's very large, but also the agenda, because of COVID, has shifted very significantly from where we were sort of this time last year. So just now, what I'm doing as an opening is basically going through, I suppose, the blinding obvious, but it is the blinding obvious. But this is sort of these factors around impact of COVID-19 are kind of lifted from IOSCO's own risk analysis or risk review, which we use to set our own IOSCO work plan at an international level. So what this is basically saying, as you can see, is that the pandemic undoubtedly triggered an unprecedented shock, and unprecedented in the sense that it was, as has been commented on certainly more than once, that the sequencing was health crisis, lockdowns, economic shock, both on demand and supply side, and then led very, very quickly to spillover effects of the financial markets. And we saw in particular, and this is something we're going to get onto later, I think, which is there was a major stress event in financial markets in mid-March, which I'm sure you're across your organization you've discussed, I'm sure, in some detail. From a market regulator as opposed to a central bank perspective, we were looking in particular, as you might expect, at investment funds and markets intermediation as distinct from bank intermediation. Of course, we did see that some funds did use the liquidity management tools that are available to them when there was the liquidity full stop across many underlying markets in March and thereafter, and a fairly limited number suspended sales, fund sales, and suspended redemptions. When it comes to central clearing, and in particular, our focus again is around, or has been since the financial crisis, has been building up the new structure of CCPs for central clearing of OTC derivatives. If you look at that, and it is relevant because, of course, in the financial crisis in 2008, 2009, that was an epicenter of stress. But if you look at the way in which CCPs performed, they did remain resilient. They basically performed the job that they were meant to do. We did, however, see the fact that the inevitable increase in margin calls and the degree to which margin calls and margin amounts were calibrated to these stresses and volatility, of course, being the major kind of component of that, had to be done very carefully to ensure that you didn't set off such a level of pro-cyclicality because of those margin calls that ultimately you'd end up making matters even worse, and tipping into financial stability issues. But we did see, I think, that the sale of assets to meet margin calls could have contributed to some aspects of that sort of dash for cash in March. And we also saw, I mean, the topic of leverage has been again front and center of policy discussions for some months, if not years now, and we saw to an extent that hedge fund deleveraging could have had a role, but that needs to be examined down the track. Now, obviously, critically, what I call in this slide exceptional measures from policymakers, that basically means central bank interventions, meant that markets remained largely resilient. Looking ahead, again, longer term impact of the pandemic and potential risks. Well, of course, public sector debt on the increase. There's a separate conversation, of course, around what kind of call it modern monetary theory and low interest rates and the sustainability of public debt ad infinitum, which I'm not going to get into. I'm a markets regulator. I'll leave that to to others to debate. But of course, we also saw not only on the fiscal side, but on the central bank side, this extremely large increase in central bank balance sheets, both from a sovereign debt perspective, but of course unprecedented interventions into slices of the corporate debt market. And what we end up with there is a question really around the potential divergence of the pricing of risk in financial markets and the economic outlook as we move through the COVID crisis. And also when it comes to central bank intervention, and as always is the case, there are, I think, genuinely serious questions to be examined around moral hazard in the future. And again, this is not moral hazard in the banking sector so much, this is moral hazard in the non-bank sector. Of course, we have a jobs crisis, but which we have now, and which also will affect economies and corporates. But I want to then sort of, move into one topic which we may also get onto in a bit more depth, which is clearly there has been a sustained buildup in corporate debt intermediated through non-bank markets. It basically is around different types of bond markets over some years. And again, there are questions around the fragility of corporate balance sheets. And I mention that because it's a linked topic, but it deserves separate examination from the question of structural vulnerabilities within intermediaries, or firms that intermediate those underlying asset classes or markets. So the question then going forward, I think, is, will there be further strains on corporate cash flows as fiscal measures may start fizzling out? What does that mean for balance sheets? What does that mean for solvency? And what does that mean for the existing stock of corporate debt when it comes to the ability to service that? And on the flip side, to an extent, I suppose, is that there has been talk about what's the phrase? Reflation trade. And if there is a degree of, or albeit possibly temporary, of inflationary pressure because of when we come out of the COVID crisis, and there may then be a sort of a steepening of the growth curve at that point, does that mean that interest rates will be set at levels that we don't quite expect? And what pressures might that put on corporates? And then, of course, all of that might, translate into risk for securities markets, which is what regulators like me and those who are members of IOSCO are particularly focused on. IOSCO priorities, we haven't actually formally set these yet, but again, I think they're fairly clear. The first of which is financial stability and systemic risks in non-bank financial intermediation. That is the subject of a huge amount of work and thought at the moment. The reason it's a priority for 2021 is that even at the beginning of this year, there was a conversation around non-bank financial intermediation, but it wasn't front and center because that was a conversation before the March and thereafter events. So it's now rocketed up the priority list. The second is just a priority: remote working, misconduct, risks, fraud and scams, operational resilience. That's really a kind of package of all the other stuff that regulators have been dealing with in the context of COVID, which is a combination of technology, working from home, misconduct in the context of particularly stressed firms and stressed retail, and whether that relationship can result in some sort of toxic results when it comes to firms potentially mis-selling or misdescribing or mislabeling products and offerings, and also whether there are a larger number, which I think is certainly the case, of consumers out there who may be vulnerable, to including frauds and scams, which we've seen. Operational resilience speaks for itself. Again, that is connected back to remote working to a large extent. Sustainable finance, that again, I think we might come on to that a little bit later. It was a big conversation before COVID. It's an even bigger conversation now, particularly around climate, and to an extent around the social in ESG. So the E and the climate aspect and the social and ESG, I think, has gone up the agenda. And I think that we are now in this conversation, particularly around climate. I think we're now at a tipping point as we run up to COP26 in next November next year. Retail market conduct, that actually is a bit of a subset of the question of conduct risks in the context of COVID. And then market fragmentation, I only put that there because we always have it as a priority with IOSCO, but the sort of flavor of market fragmentation changes over time. We did publish a report earlier this year with a set of best practices around what we call deference, a word that was first used in this context back in just after the financial crisis, one of the G20 meetings, but is now, it's heavily resonant because of, not least because of the imminent separation of the UK from the EU, but also in other contexts as well. So, and we're continuing to work on market fragmentation issues now. So that's all I really wanted to start with, and then we can have a chat, I think, about.
That's a very, very helpful overview. Ashley, lots of interrelated issues there. We'll spend quite a bit of time on non-banks. We've got quite a few central banks on here today. We've spent all year talking to them about the impact of QE. We started the year, for example, the session with John Cunliffe at the Bank of England, who's responsible for financial stability, and he was worried about the impact of low for long already then before COVID and the latest wave of QE, and what to do about non-banks, which are essentially securities vehicles and therefore regulated by you and your colleagues. So we'll spend quite a bit of time on that, and we'll also, you haven't mentioned tech here, but we'll talk a bit about fintech. I wanted to start, you've touched on it already, with the immediate impact of COVID from a securities regulatory point of view. You talked about operational resilience, working from home, and so forth. Tell me a little bit more about the immediate concerns and ameliorations on the immediate impact of of the crisis from operating markets in that environment?
Yeah. Well, actually, I mean, now we're a little bit, few months down the line, it all went quite well. So from a market's perspective, because we didn't know that when the lockdowns first went into place and working from home became the norm. We had to be pretty agile, I think, in a number of respects. The first of which I'd say is to do with as supervisors, how do we deal with specific regulatory expectations that had to be fulfilled in different ways. So I think that was things like the way in which you record trades was one that virtually every regulator had to deal with, and how we had to adapt to different ways of recording trades in a way that's sufficiently reliable so that the outcome from a regulatory perspective didn't differ from the outcome that we'd have normally. And I think we by and large achieved that. We had to make sure that ourselves, that the way in which we supervise firms moved away from on-site inspections for obvious reasons to other methods, which we did, I think. We had to look at the way in which AGMs were physically held, or more accurately, not physically held. And we had to look at audit as well. And there's still, I think there's one of the questions was, how do you practically carry out an audit when these sort of restrictions are in place? And the second angle around audit was much more around audit quality, and an issue which continues, which is very difficult questions around going concern in relation to those corporates that are in the midst of fiscal or government assistance, and timing around that, and underlying strength of the business, and judgments around the length of the crisis for that particular business. All of those in the mix. And it's a difficult conversation. I know it's a difficult conversation often between auditors and their clients. So that's the other angle to those. So those more sort of practical adaptations. I mean, operational risks. I think actually the encouraging thing was that when business went largely online, it worked pretty well, not least because I think that business was largely online beforehand, but conducted from offices, not from home. So it wasn't such a disruptive event as that might have been expected. We were, I think, concerned nevertheless that increasing dependence on connectivity from home would then result in more outages. Would there be more vulnerability to cyber attacks? The answer to both of those is yes, there is greater vulnerability, but we haven't seen anything systemic to date. But then it also, I think it sort of elevated up the agenda some of the issues, the core issues around technology that we've already been looking at, which is increasing reliance on third-party providers, concentration risks around third-party providers, and this sort of relationship between externally sourced technology, which then becomes a regulated activity in itself, or could become a regulated activity. And there's a central point, which is, do you regulate that activity via the licensed firm or the regulated firm, or do you expand the remit? Which is a continuing conversation. Other than that, just the final thing I'd say, I think the markets, as in share markets, derivatives markets, etc., regulated markets, they work pretty well, and they did handle, I think, trade volume issues and volatility issues pretty well. So we've seen, I think we're quite pleased with that so far, at least.
In other words, so far so good in terms of systems stress. Just a quick supplementary question: the original sin, so to speak, that securities regulators have to worry about, of course, is insider trading in all its various forms. Has that been more of a headache, given that people are not sitting together in an office and they're scattered around their houses. Has that been an increased worry for you?
It's not, well, in the context of all the other worries we have around markets and financial stability and COVID, no. It's not really up there in the, but I don't think the fact that people are sitting at home as distinct from the office would really affect incentives to inside a deal or opportunities to inside a deal. The reality is also that normally you would only really detect you'd only come up with some potential outcomes around insider dealing a bit down the track, because that's really an enforcement activity, depending on evidence gathering, et cetera, et cetera.
Yeah, good. Okay, we've had an initial question in from the audience, which I'm going to put. I think I know how you'll respond. The questioner says, why are we seeing capital markets around the world performing great, but the real economy with unemployment very high, as governments issue lots of monetary and fiscal stimulus? I think the answer to the first part is the second part.
Yeah, I agree with that. That's exactly right.
You did mention the disconnect between essentially valuations and fundamentals, and we know that Norges Bank, for example, the sovereign wealth fund in Norway is profoundly worried about that, and we've heard it elsewhere. So it is something that you're watching. There's not much really you can do about it, I don't think.
Yeah, I mean, the markets are largely set up so that price discovery is efficient and effective. And if through that mechanism you end up with markets where they have been certainly in recent days, when records have been broken around equity markets, and at the same time with bond markets, you've had continuing extremely low yields. You now have kind of dividend yields that from equity markets that outstrip the bond market yields, and all of that happening. There are a number of explanations, I think, but the primary explanation tracks to a phenomenon that isn't a COVID response phenomenon by central banks. It's a central bank response that was initially put in place in the aftermath of the financial crisis. I think we're all pretty well aware of that. I don't think there are, nevertheless, any. I just think it does worry us, because the whole point of price discovery and risk premium and all the rest of it that goes with it is to enable, in an old-fashioned way, savings to be efficiently converted to productive investment. And if that mechanism is distorted, the pricing mechanism is distorted, you do then end up with an underlying problem. But now you end up effectively, as policymakers as a whole, you end up being boxed into a corner, because once you've got here, how do you unwind it, given there are so many concerns around making sure that that economies aren't affected in the short term by a withdrawal of policy? And we've had the same issue for some time now, as you know.
Well, and we saw the taper tantrum a couple of years ago showed us that markets resisted quite tepid attempts by the Fed to try to go back to normal policy. So, and that was before COVID. So I think they all know it. They're not sure how to get out of it, as you say. I've had a question in, intriguing. I don't know if you have any thoughts on this. Why are capital markets seeing lots of transactions with big stocks and these stocks overvalued, while small players are not able to raise capital easily? I haven't seen that statistic, but it's an interesting point.
We see that in Hong Kong, actually.
Right.
Just the market I'm most familiar with. So if you look at the Hong Kong markets, the vast majority of interest is in the big caps, and the smaller caps get precious little. I think there are a lot of factors here. I'll just point out two. One is passive investment and index tracking, ETFs, etc. So index inclusion has become more and more and more important over the last few years, to separate out those stocks that trade and those that don't. And there's also, I think, there's been well, again, pretty well covered, quite a major bias around smaller businesses to stay private for longer. which then sort of orphans the small caps that may have listed before that phenomenon took place, because fund flows are increasingly interested in, or funders are particularly interested in the private markets, as distinct from the public markets for companies that are sizable but not of the size to be index constituents.
And we have seen that elsewhere, this going private trend, particularly the UK and the US too. And we've had some questions in about tech, and I do want to get onto that. It's a very interesting and confusing area. I want to spend a bit of time actually on non-banks. You've raised that already, as I have. We hear a lot of worry about them from central banks scratching their heads about financial stability, less worried about banks, which have, as you know, had to double their capital buffers since the GFC and so forth, had their business models heavily regulated. But there is a worry about the leverage that you've talked about that's built up over this low for long period of negligible interest rates in developed economies. And these vehicles are, of course, market entities and securities types. So what can market regulators do to mitigate an incoming disaster if, for example, we had a version of the taper tantrum in those markets when policy is ever reversed?
Yeah, okay, well, look, the conversation around, to start off with, there is this phrase which we're now stuck with, which is NBFI, or a sort of acronym. It's not exactly an acronym. So non-bank financial intermediation was replaced in the Financial Stability Board G20 world, was a replacement for shadow banking. So the shadow banking term was ejected, and then NBFI came in. But NBFI is really a shorthand for a range of market intermediaries, non-bank market intermediaries, but with a particular focus on investment funds. So what we're really talking about here mainly is investment funds. That's the first point. Second point is that there's been a conversation around liquidity mismatches as an analog in funds, as an analog of maturity transformation, basically, and the risks that gives rise to from funds to banks. That analog. There's a conversation around that for the last 7 years, I'd say, something like that. But the March liquidity crunch or evaporation this year, and the fact that central banks did step into markets, they didn't really, apart from, as far as I'm aware, in some money market fund instances, they didn't step into the funds themselves. As distinct from some of the actions that were taken in the 2008-2009 crisis in relation to banks. They mainly stepped into the underlying credit markets or bond markets. But nevertheless, that raised an issue, which is if the banks are stepping into these markets, which are mainly intermediated by non-banks, does that mean that in effect, those non-banks were effectively bailed out? I use that term very loosely. I don't mean bailed out in the sense of 2008, but were nevertheless rescued, say, or by that central bank intermediation, because they have embedded in them structural vulnerabilities, particularly around liquidity mismatches, that would otherwise have meant that they would have caused some serious issues, potentially even a financial crisis, if there hadn't been that intermediation. So that's the kind of it's a question, and if you unpack that, it boils down to a sort of a piece of policy work, or a broad sort of set of policy questions for policy decisions to be made, which is effectively, given that there was that central bank intervention in March. What are the parameters of its potential use in future in non-bank markets? And against that, what should the optimum resilience of non-bank finance or funds look like? What should it be so that central banks have a much better fix on the chances of them being called on to do the same again?
And we're back to your moral hazard point, aren't we? We're back to your moral hazard point at the beginning.
Yeah, and one aspect of this, I mean, it'd be very difficult for you anyone to conclude, I think, that the intervention in March had a moral hazard component, because that was an emergency intervention resulting from a shock that arose outside the financial system that was, to all intents and purposes, completely unexpected. So, in other words, it wouldn't be credible to believe that behavior within funds was in some way predicated on an expectation of central bank intervention as a result of lockdowns after a pandemic. It's just not credible. So, but now that central banks have intervened, that does give rise to a question around moral hazard in future, because now we've been through that experience, and all that sounds very philosophic, but I think it's actually a real issue. But the key point is, if it's the case, and it is an if it's the case that there is an argument for adopting a different approach to resilience in funds, query what that might be. Well, two things happen really. The first of which is what level of resilience is appropriate, set aside this question of central bank intervention, for the future. The second is what level of resilience is appropriate, given that the whole point of these investment vehicles, or a large point, is to support the real economy. Because after all, unlike banks, they operate usually on an agency basis. They have an agency relationship with their investors. They do not operate balance sheets in the fund itself, in investment funds. And as a result, you do not want to get to a situation where you've effectively suppressed what they do, which then leads to impediments to the way in which they support the real economy, and particularly now, because real economies are under stress, and we need to ensure that investment continues and productivity is supported.
Would you say that of course, there's a distinction between banks going wrong and non-banks because of fractional reserve banking, which, when it fails, is very dangerous. Would you say that with non-banks, it might be better to take an approach of caveat emptor, but be very strict about the way that these things are sold and presented? Would that be the better answer? Seeing that actually the financial risk is a bit less than a bank failing.
Yeah, I think the first thing is unlike banks, funds are massively heterogeneous, huge diversity in portfolio construction, which goes to the underlying markets, etc., massive diversity amongst funds. That's a big distinction, as distinct from banks or core banking, which is pretty uniform. So that's first point. That I think that would militate to a different approach. Second point is that many of the liquidity risk management tools that are used, yes, they are designed really from an investor protection perspective. They're well flagged in prospectuses and in fund documents. They aren't resorted to very much. When they are, there's lots of publicity. So you've seen the examples, obviously Woodford and and other examples more recently in the particularly in Europe. But on the whole, I think there is a question out there as to the appropriate level of a kind of macroprudential approach when it comes to non-bank finance. Because as you say, I don't think the nature of the risk is the same. And in particular, we've got to recognize that these are investment markets. These are not bank lending markets. But there is a complication, which is that the there is greater interconnectedness between the two, between banks and non-banks, which we do have to interrogate before we come to any conclusions. But perhaps maybe one good example is money market funds, because that's so in relation, I think there's also, if you saw in March, there was money market funds encountered more problems than others, than open-ended funds. And I think one of the issues now is really to think hard again, not least because this has been done after the financial crisis as well, is if there are issues in money market funds. So for example, structurally, there seem to have been cliff effects whereby gates and redemptions were tied to liquidity levels, both in Europe and the US. And as you get towards those liquidity levels, that's an incentive to bail out from the investor perspective. So there are kind of, there are specific fixes that one can look at in the context of money market funds. But if you think about it, money market funds, do we approach them from a resilience perspective or strengthening their resilience on the assumption that they are cash equivalents? Or do we look at it the other way around, that they are more investment funds? Because at the moment, there just seems to be a bit of a gray area there, and there has been for some time. And you have to have clarity around this to make good policy choices.
But do you see they have different treatment perhaps, but also they're dealing often with government debt. So governments obviously need financing markets to function in an orderly way, and they're worrying about that in other ways. Central banks can step in and did, but also issuers, as we know, are building up war chests to deal with disorderly T-bill markets, money markets, and so forth. So does that segregate those things because they're government related from how you might treat corporate debt vehicles, for example?
Yeah, I think it does separate out. There were specific issues in treasury markets earlier this year, but I think actually more importantly, separating out the money market fund world from open-ended investment funds. There's a huge difference between the two, because money market funds interact with short-term markets mainly, and treasury markets, but in the non-sovereign markets, it tends to be commercial paper and similar. And so, I do think there's a legitimate reason or legitimate pretext to look at, are they cash equivalent? What is their role as providers of short-term funding to businesses and banks? What is the liquidity in the underlying markets? And this gets to this question of dealer behavior, which I hadn't mentioned previously, but it's obviously a topic of debate. Underlying markets and liquidity then goes back to dealers, and dealers tend to be sitting within banks. So, there is a question around dealer behavior and incentives. And of course, as I mentioned earlier on, the role of central bank interventions. So all of that in the money market world, fund world, I think is important. But one of the reasons to look at this, I think, in through a different lens, is that fundamentally this is about supposedly cash-like or cash equivalent short-term markets, which perform an incredibly important role, regardless of the historical origins of money markets some years ago.
In the interest of time, we could talk about this much longer, I think, but in the interest of time, I'll move on to some other themes. We'll come on to tech in a bit, and we've had some questions in about that are interesting. Just briefly wanted to touch on LIBOR. I don't want to spend much time on this, but we have had a question on it, and it does relate to the orderly operation of markets and the other themes that you mentioned. How is IOSCO dealing with LIBOR, as a lot of contracts and derivatives are in LIBOR, and switching to new rates, and how are you observing the transition and the adjustment?
Well, we were quite centrally involved in the first sort of iteration of the LIBOR debate, which is more around conduct. Yeah. And we came out with the guide, so the principles that then led to a a rejig of those markets from a conduct perspective was basically under our wing. That's because in large part we're conduct regulators. So, and that was addressing specifically what we saw happening around, was it 2012? Since then, now that was a fix. That was a fix to the problem, the conduct problems that were uncovered. But then that fix wasn't good enough because of this core problem of a lack of underlying transactions post-financial crisis, which then persisted. So we haven't actually had as IOSCO a central role since then, because but we are participating because the work has moved more into the realm of Financial Stability Board and something called the Official Sector Steering Group, which I think is still co-chaired by Andrew Bailey, actually, in the UK. And they are then, that group, together with ISDA and others, are looking through all of these sort of granular efforts around tough legacy contracts and such like. We do recognise that it's a bit of a grind getting through all of this, and of course different jurisdictions are handling this in different ways. In the UK, trajectory is a bit different to Europe. The fallback or the replacement rates are different, and they take effect at different times. And I think the US has just announced, I think the Fed has just announced effectively a bit of a delay around, or some delay around how they're doing this. But I won't go beyond what I'm directly involved with, so I'll leave it there.
Fair enough. As you say, I think you're hinting at what looks like a bit of a fragmentation there. We've run a separate session on LIBOR transition, so we won't spend too much time on that. But I think one worth watching. It's slightly following the rule of unintended consequences, or potentially will at the moment. But we'll keep a watch on that. I want to move on to ESG. You mentioned that at the beginning, Ashley. Lots to say about that. Lots and lots on the move, particularly in Europe with the Next Gen fund coming, green bond markets, so sustainability bond markets really moving into gear. So are regulators and governments. Mandatory disclosures are on the way. Investors and asset managers are devoting larger portions of their portfolios and products to the associated assets. There are problems still, and they're not new. Ratings, labelling, standards seem a bit unclear. How are regulators thinking about this sector from a securities point of view?
Well, actually, I think, as I said earlier on, I think it's all coming together. We need to bite the bullet on this in the next few months, because if we don't, there'll be increasing fragmentation, just similar to LIBOR, But I think the overall framework around, I'm just going to concentrate at the moment on climate, because it's important, and it's a good kind of example of how this framework might be coming together. I think the framework is pretty much there, which is, from our perspective, and much of this is around, it's around disclosures and taxonomies. So, by and large, securities regulators are disclosure regulators, at least in origin. So that's the perspective through which we view this. So the levels are basically this, in my view. First level, sustainability disclosures at the corporate level. What I mean by the corporate level is, is listed and otherwise, and it's real economy disclosures. A huge amount of activity around there, like TCFD. They have kind of a 4-pillar approach, and many other standard setters. And those standard setters, there are some issues. Well, those standard setters standards tend to overlap. Now, when you have overlapping standards, you end up then with companies able to pick and choose what standard suits them. You have confusion around sustainability ratings. You have the increased potential of greenwashing through the financial system, etc. So you have, but the most important aspect of all of that, they're all important, but the most important is, given that climate is a global issue, you have to have sufficient comparability. or the ability to compare, which means consistency of standards. They don't have to be identical, but they have to be sufficiently consistent to enable investors on a global level to compare them reliably and then make investment decisions around that. It's a very simple proposition, but it's hard to deal with. But I think there is a potential turning point now due to the fact that firstly, we as securities regulators, I think, have struggled a little bit about how do you hardwire into regulation corporate level disclosures which are fundamentally forward-looking. I don't mean not forward-looking in a conventional way, forward-looking for decades potentially. And this is to do with the fact that that disclosure is normally based on scenario analysis, and this is the sort of called double materiality of the risks to your business on a forward-looking basis and your strategy around that derived from climate change, analyzed into physical risks and transition risks. And then separately from that, your impact on the environment and your impact on emissions or your emissions profile. And that's a double materiality. The second one is hard, but it's a little bit more contemporaneous. The first one is important, but it's forward-looking. So where we're getting to now, I think, is that firstly, the sort of 5 major standard setters, GRI and they're pretty familiar, SASB, etc. They have launched a project earlier this year around convergence, which is great, because then there's a realization or an understanding or a willingness to converge the standards. Secondly, IFRS has now consulted on the prospect of putting together a parallel board to the accounting standards board, which will be a sustainability standards board. And the prospect is basically reversing the converged standards into the IFRS system. And what that gives you, well, firstly, it recognizes that corporate disclosure is usually a product of company law, listing rules, et cetera, but a big part of it, of course, is financial statements and some of the sort of management analysis and disclosure around financial statements, which is IFRS or GAAP. And so it's a good place to sit this, we think, and it gives you not only convergence, but it gives you governance. The governance system of IFRS is pretty robust. IOSCO chairs something called the monitoring board, which is the public interest oversight of the IFRS standards production process. And it also prospectively gives you assurance, because the analog of audit for financial statements could be something similar, but it would have to be modified around sustainability disclosures, and the first type that's been looked at is climate. So I think all of that looking good, actually.
Do you think we might get to a stage that we have with the credit rating agencies, whether there are 3 or 4 of those, there are more in China as well, but it's a limited number of institutions using a pretty familiar set of gradings, albeit they're private companies with conflicts of interest that arise, as IOSCO knows. Do you think we'll end up with that, or will we invent something new for ESG, which rates in a different way through public bodies and kind of in the way that you've just been describing? What would you expect in 10 years?
Well, the credit rating industry, when it comes to bond markets, fundamentally is partly predicated on the fact that bonds are so diverse, and the disclosures behind the bond markets are somewhat different to the disclosures you have at corporate level informing equity markets, basically. So they are they're central parts of the system, and there are all sorts of issues around that. I think the reason I mentioned corporate level disclosure and the fact that we may now be in sight of an answer to this is that it's not so much about ratings. And I know in the products field there is an issue around ratings. This is much more around unless you have good information and disclosure at corporate real economy level, the rest of the stack of climate finance approaches just don't work. So the rest of the stack is asset manager level, a sustainability integration into asset manager processes and disclosure. The other bit of the stack is central bank stress testing of insurer and bank balance sheets. Another bit of the stack is taxonomies. Taxonomies have to latch on to underlying information as well when they're applied. And then that goes across into products, because products are very closely linked to financial products, and whether they're green bonds or otherwise are linked to taxonomies. And so although ratings is certainly part of the issue, and I do think that single ratings around sustainability don't make much sense, because the actuality is much more complex and it's much more segmented than a rating, and certainly they can lead to greenwashing. And in fact, IOSCO has a specific project. We have three elements of the work we're doing in this area. One is disclosure, corporate level disclosure. The second is asset manager level integration. And the third is actually ratings, etc., and a good look at that. So it is important, but I don't think it's necessarily a dominant feature of this area as it is in the bond markets with conventional credit ratings.
Thank you, Ashley. We haven't got long left. We may run over, if you're okay with it, a couple of minutes if we need to. But moving on to the last segment, we've had some audience questions about this, which I'll come to. The whole glorious area of technology in markets. ONFIF has devoted a lot of its time to CBDC this year and associated issues relating to payments technology as very advanced, as China is probably ahead of everyone else in that field as well. But it's clear that even the well-informed are struggling to work out where banks end, where a range of payment systems start, which version of money is moving across the two. We've got cryptocurrencies, which often behave like commodities, although their technology will probably be used for CBDC. Very complicated area. How are securities regulators approaching this space? And then we'll talk about your own technology to collect information, to RegTech as well. What's going on in this area for you?
You sort of summarized it. There's too much to pack in, but I think I know we don't have much time, so I think the central issue for securities regulators, and this might sound a bit old-fashioned, was summarized actually some months ago by Andrew Bailey in a meeting or an event we were at, which is when a firm comes to a regulator and says, it wasn't my fault, it was the machine that did it, isn't good enough. And that's kind of
we saw with Wirecard. That was basically the Wirecard answer from certain places.
Yeah, it was a kind of version of the rogue trader excuse, nothing to do with our culture and such like. We just had a bad egg. And so so that kind of, I think, underlies a lot of the work we have been doing. We have published reports around best practices and such like around AI and ML, of course. That's one strand, and that's about responsibility, accountability, and explicability and auditability of those new techniques or newish techniques of interacting with both retail markets, but also obviously in trading. So that's important, and we have it's not, we haven't got to the end of that yet, but it's that area of responsibility, accountability, explicability, auditability is really important. I think the second area of concern I mentioned earlier on, which is outsourcing. Where should regulation, conventional regulation end, and where should something else start? I'll just give you an example, but it's a very specific one to kind of securities regulators. We have been in Hong Kong looking at, and we have an IOSCO as well, actually, looking at cloud. So an issue for us with cloud computing and the storage of records in cloud computing through cloud computing techniques or outsourcing is that we operate, again, in a rather old-fashioned way, that as an enforcement agency, we need to have access to records. And we only have access so far as our jurisdiction extends. And our jurisdiction extends normally territorially, pretty much. I mean, it's a bit more complicated than that, but for present purposes, that's what it is. If you store records on the cloud where the service provider is elsewhere, that raises a whole heap of questions, both around access to those records, and secondly, and quite importantly, around the ability to verify that those records are accurate and robust. And that verification often needs to be provided in the context of court proceedings from an enforcement context. So what we've been doing here is having a conversation with the industry around where does the responsibility lie to enable us to have the same access we would normally have if records are kept in Hong Kong. And our law says that the records should be kept in Hong Kong. Nevertheless, they're kept on the cloud. So that's just a flavor of it. We're probably going to get down to an answer which is firmly in our jurisdiction by placing the responsibility on the equivalent of senior managers in our firms here. But that's it again is an illustration of the large footprint that technology places around financial services way beyond jurisdictions, and how we structure.
Just to clarify that, so are you saying in the cloud service provider or their servers need to be in Hong Kong? Is that what you're saying there?
No, because you can't do that. No, you can't. No, it's to do with who has the responsibility to ensure that we have access to records, notwithstanding the fact that they may be stored on servers outside Hong Kong, and who is able to verify that the way in which those records have been stored is sufficiently certain and robust with the right sort of trail and audit around it that is sufficient to demonstrate that they are genuine in court proceedings.
That sounds quite tricky. We can go into that at a later date in more detail. I think a couple of China-specific questions on this. I was talking about the CBDC developments also in China. We know that PBOC, one reason they're doing that is to avoid, we think, a private sector duopoly in payments systems. We've just had a question in, or had an earlier question in. China released a draft on anti-monopoly law and rules on online micro lending. How will their drafted regulations affect the future landscape of fintech regulations? So very similar point.
Yeah, it's actually interesting. I mean, this was connected with the suspension of what was going to be the largest IPO in the world ever, which is Ant Financial, now a few weeks ago. That was a listing that was going to be equally shared as between Shanghai and Hong Kong. There were sort of two parts to this. Firstly, before the listing, before the float took off, the impact day, there was a clear, signal, and before it was suspended from or around the same time from the mainland authorities that they would be looking at whether or not, so effectively Ant operates in the micro lending space as a algorithm-driven intermediary, intermediating many banks with many, and I mean many, borrowers. And in a sense, what then is happening is that the credit assessment process or function within the banks is effectively outsourced to technology. And effectively the suggestion with these regulations is that the technology firm has to have skin in the game, and the suggestion that it has to keep a proportion of the risk on its own balance sheet. At the moment, there's precious little. The risk is with the balance sheet of the banks. First thing, and the antitrust or monopoly issue again is a different point, and it's kind of obvious one, which is around concentration in payment systems, but also around this sort of intermediation as well. And I think the interesting thing about that is stepping back from the, what happened with Ant and the fact that its listing suspended and such like, is that China is effectively dealing with some of the same issues in sort of the same way that Western countries are dealing with them. If you think about what's being raised here, because the underlying issue is around big tech concentration, and it is around the use of technology to intermediate with markets in different ways, which then place, for example, banks in a very different position to which they were used to, because one of their critical functions effectively has been outsourced to technology. And both of those topics, I think, the competition angle, big tech angle, and that are very, very live issues in the West. So what I see is kind of the context is a bit different, because the political context is, obviously, but there is a kind of commonality of concerns and policy development.
Do you think that bank regulation is coming tech firms' way? That would be an interpretation of what you were saying.
Well, if you're basically saying a tech firm up to now could operate purely as an intermediary, not engaging its balance sheet when distributing microloans, or but in future has to retain risk on its balance sheet, the answer to that would be yes, wouldn't it?
Yeah,
at least partially. Yeah.
Good. I've got there's a final question. I think you may say no comment to, but I thought I'd pass it on, then we'll close up. Does the SFC Department of Justice plan to appeal the Convoy Global Holdings case?
I can't comment. It was there was a judgment. I think it was where are we now? Wednesday, day before Monday. That is too early to say whether or not we are going to appeal or not. So watch this space.
Fair enough. Super. Well, Ashley, thank you very much. A quick tour, I have to say, of incredibly complicated, important issues, but I think you gave us a really, really good flavour for how they're being thought about. Lots more to be said, but thank you very much indeed, and thank you everyone for listening. It's an extraordinary time in financial markets and banking. And the global economy. So watch this space. Ashley, thank you very much indeed, and thank you all for joining OnFIF this afternoon, this morning, and we'll see you again soon.
Thank you very much.
Thank you very much. Bye-bye.